Howdy, Jacob here. Today we're looking at the company Amgen in the biotech industry. 167 billion market cap on 217 billion enterprise value. They do have a lot of debt here, but it looks like they've made a lot of drugs that I'm sure a lot of us have heard about. They're specifically in treat plaque psoriasis, rheumatoid arthritis, psoriatic arthritis, Otezla. Okay, I've heard some of those. Um, Growth has been low single digits over the last 10 years, but fairly consistent growth. Gross profit is gross profit margin is down, operating margin down, but it looks like it was increasing to pre-COVID, and then maybe some of their drugs went generic and it hit their margins pretty heavy. And return on invested capital, low single digits, very likely above their weighted average cost of capital, so they are still producing business. That's a good sign. Balance sheet shows a lot of debt here. So 10.9 billion cash on hand with 1.4 billion short-term debt, 63 billion long-term debt. Very likely an acquisition here, increasing 25 billion. Let's see what that was. Cash flow statement. Come on. All right. So huge acquisition, 26.9 billion acquisition. And we see that they did issue it through debt. So the last 4 years, really, they've just been issuing debt, not caring about it. There's going to come a time when it comes due where they're going to need to pay that off. And so, like I always say, first let me look. 5-year average free cash flow about 9 billion. 9 billion in relation to that 63 is about 9 times 7. Okay, so yeah, it's a lot. We'll say that. It's a lot of their free cash flow, 7 years. That's a hefty amount. When is it due? That's always what I like to say. They do have a lot of cash on there, 11 billion, but even in relation to the net debt there is 50 billion. And I always bring up the classic example. It's just the easiest to think about. We as individuals, we own a home. It might be, we might be 800,000, a million in debt, and our income is $100,000. So yeah, it's 10 times. Pretty concerning, but it's due over the next 30 years. Most companies' long-term debt is due over the next 5 years. At least from what I've seen, 3 to 6 years is very likely the most common of when debt is due. It's usually due in different time periods anyways, but very likely over the next 6 years that debt is due, and it's 7 years of their 5-year average free cash flow. So it's a well-established company. They'll be able to refinance, I'm sure, but I really don't like this acquisition for that cost, going just into debt for it. So use of cash, we can see, is very heavy on the acquisition side. A little bit of share repurchases. Their dividend pays out 4.6 billion, which is about 50% of their 5-year average free cash flow, and 2.8%. So it's pretty hefty dividend, pretty hefty share repurchases, and then good amount of acquisitions here. So let's start making some assumptions. So for me, revenue side, probably looking really small. Let's do 2. And then, I think they're a well-known company, but I'm having a dampened PE from their debt. I'm trying to base PE I'm trying to take a little bit of that debt into consideration with their PE instead of just doing it based on their market cap, their enterprise value. So maybe this would be more like a 15 on their market cap, but based on the fact they have 50 billion net debt, I'm putting them as a 12 PE. Margins, let's do roughly in line with averages here. Let's do 28, 32. Share change. They haven't bought back recently, but it'd only take 1.7 billion. Stock-based compensation, 1.8. I'll say they buy back 1% of shares. They bring that back. Dividend is already paying out 50%, but have they increased that? Yes, they have. Okay, they've been increasing it very heavily. I probably won't go that high because it's already 50%. So let me just increase it with the revenue growth, essentially, and the earnings growth, roughly. And we're saying it's 60% overvalued. It needs to drop 60%. It's not 60% overvalued. It needs to drop 60% before you get the return I'm looking for here. And again, a lot of debt here. I think it's a great business. These margins are great, but I don't like the declining margins, and I don't like the debt that they have. But otherwise, good business. Just going to be tough for a business like this to get to a price point that I think is attractive, which is fine. If I never own a business that I think is great, that's totally fine. There's thousands of businesses out there that I'm able to buy that I might, are a better deal for me in my particular case. So I hope you enjoyed the video. Have a great rest of your day. Thank you.